to this webinar looking at a whole new way of applying modern portfolio theory to the holding of precious metals with a new business which consistently outperforms the precious metals. Now, joining me, we have David Mitchell, we have Matt Colohan and Robbie Hoyscock, the team. David, tell us something about yourself.
Yeah, I started off in the investment banks in the early to mid 80s. Started off as a systems coder and moved into trading, and then spent my professional career as a trader in banks across the world, from HSBC to Swiss Bank Corporation, Rothschilds, etc. I left banking in 2007, beginning of 2007, and started investing my own money and running a small fund. I closed that fund down in 2010, effectively achieving what I wished to achieve because of the global economic crisis, which I was very much focused upon. And then we moved to Singapore in 2014 to build up these bullion companies.
Fantastic. And you're joined by, well, he's not with us today, Scott McRae is one of your partners. And indeed, we've got Matt Colohan. Matt, you're part of the team there. What's your role within the business?
I'm the Chief Information Officer. I guess I have a mechanical engineering background. Started off as an engineer with BHP, then moved into various operational and management roles in the agricultural and mining sectors. Primarily focused on ERP and business information systems. So I've had a lot of experience and background in developing BI systems and the tools we use to develop the Auctus algorithms.
Fantastic. So product design, which is something we'll come on to in just a moment, is clearly your area. And Robbie, you're a key part of the team. Marketing?
Global sales, in fact. So I look after all sales for the group, including IPM Group, which is Indigo Precious Metals, and the Gold Bullion Australia Group in Australia. My history and relationship with Auctus started about 2 years ago. I actually have a legal background. I did work in the regional treasury for City for a few years, and for many years since. But my entry to Auctus was really as a result of my father, who was a very happy client who he only invested in 2019, and by sort of 2020 he was up close to 100% in about 18 months. And it was at that point that I also followed him into Auctus as a client, as an investor, and then soon thereafter joined the team, which is an interesting way to approach it, really, as a sales director, when you really understand the models, when you understand the returns, you understand unique points that we offer to clients looking to actively manage their portfolios, and then taking that out to my network and obviously the wider bullion clients across the group. So I'm a client first and foremost, and the global sales director secondly.
Thank you. Well, that leads us directly into talking about the product itself and the company. What is the background of the company, David, in terms of the gap you're looking to fill? What makes you different?
Yeah, I mean, to be honest with you, I'm pretty agnostic about asset classes, particularly precious metals or any particular asset class. I'm much more interested in the macroeconomic landscape. And very much that landscape was pointing towards precious metals becoming an extremely important asset class, really moving forward from 2015 into the mid-2020s. So hence, I started to build these companies up in Singapore. But it became, probably because of my background in trading, it became much more relevant to actually factor in the different dynamics that were driving the metals, and to actually look at what actually drove metals in the first place, rather than just looking at them as a strict precious metal investment class. What are the individual drivers of each individual metal? At which point I was introduced to Matthew, who's on today, and Scott, and we gelled and we had the same business approach and how we wanted to move forward, especially with a much more accurate and much more macro pictured portfolio realignment and based off different dynamics, and we came to we came to a partnership where we pulled out the actual core of Auctus, and then working alongside Matt built out the algorithms, and we worked very closely in building out the drivers of those algorithms and what to look at and how to run them.
Why be in metals, and which one?
We've obviously seen an escalation in asset prices across the board, particularly stock markets that are trading at well-recognized ratios of the highest multiples we've actually seen in probably 50 years at least. Property markets are extremely elevated, and the asset class itself looks extremely elevated. We've talked about the move into the commodity complex because of the extreme lack of capex, but portfolio managers now are looking for diversification. You're seeing debt loads that are damaging future growth picture. You're seeing the West and central banks pushed into raising interest rates that could actually hit into stock markets correcting on the downside, and also the property markets correcting on the downside. So, and the bond market obviously doesn't look particularly good value at these particular yields. So you're seeing a fall in bond markets and a rise in yields. So portfolio managers and individuals are looking for a diversification. They don't want to be in cash because cash is being negatively affected, negative nominal interest rates being debased, active debasement. So we're looking for a hard diversification. And metals look incredibly undervalued, to be honest with you. We can argue that metals are at least 2 or 3 times or 200 to 300% undervalued. So I'm not necessarily talking about gold here. I think, you know, our long-term picture is for probably a 70 to 80, maybe up to 100% rally from here over the next 2 or 3 years. But the other metals in particular look extremely exciting and significantly undervalued.
This isn't a fund, is it? It's actually an advisory service that you're providing to clients. Is that right?
Exactly. So each individual client has got their own vaulted metals in their own vaults, wholly segregated, insured by Lloyd's of London, independently audited. What became much more relevant to us is clients generally tended to move into precious metals, and then it was a static holding within the vaults. And you know, you do get several years within the cycle where they just simply underperform. For example, 2021, where effectively they're paying vaulting fees and they're holding metals and they're collecting dust, and they do not see it as a performing asset.
And it would be fair to say the traditional way of holding precious metals would literally be buy and hold, wouldn't it? It would be, for example, buy a load of physical metal, put it in the vault and forget all about it and hope to ride the wave. There can be a more active way of managing that portfolio, can't there?
Yeah, I mean, that's obviously the traditional, very old school static holding, but it doesn't take advantage of the different pricing anomalies that appear between each of the metals. You know, gold is a monetary metal. It's a hard monetary metal, where the other metals are much more driven by industrial supply and demand metrics, and that's something that we're very much interested in, because you do see extreme pricing anomalies between the metals. I mean, you see it with obviously the gold silver ratio, for example, which is in the simplest form. You see that ratio moving, you know, all the way down in 2011 down to 30 and all the way up to 125 to 1 last year. It's, you know, you get these huge pricing anomalies. But then if you look at the other metals and the drivers within the industrial space, looking at trend changes, pricing anomalies, supply-demand deficits that are appearing, or indeed surpluses that are appearing. So you can hold a precious metal, which is the intention of the investor, to diversify against an overall portfolio of assets, but then actually to outperform a static holding, which was our intention.
We'll come on to performance in just a little while, and I know you've done significantly better than, for example, gold may have done had you had a holding in that. But so the product essentially is an advisory service. Clients buy their own metal. It's allocated and segregated, vaulted, and we'll come on to detail around that with Robbie in just a moment. And it's fair to say that you run algorithms to evaluate the discrepancies or price differentials between the precious metals, and you advise your clients accordingly. Would that be a fair description?
Yes.
What are you measuring to give you signals to buy or sell a particular metal?
There's a number of different factors. Obviously, I can't go into the 11 secret herbs and spices, but we're basically, what the models do well is determine comparative value good opportunities for entry points for certain metals and moving out of others. I guess, when we first came into the industry, gold, was the standard. It was a diversification piece in a larger portfolio, and it's because of its static nature and its perceived negative yield. It was considered a necessary evil. So one of the biggest frustrations we saw is that you couldn't generate a yield out of that gold. So we thought if we could develop a product that utilizes the relationships between the precious metals, could identify opportunities to move between those precious metals to turn that initial 100 ounces of gold into 110 ounces of gold. There was an opportunity in the market to sort of provide that service.
Fantastic. So, if I understand correctly, you're measuring something in the region of 55 different variables. Is this driven by fundamentals? Is it driven by technicals? A combination of all of the above?
Combination of the above. Like we do monitor a lot of the technicals. We do look at some of the supply demand basics, but primarily it's driven around technical levels.
Fantastic. And I know you have Dr. David Davis, who also advises the group on platinum group metals. I think he's a well-respected analyst, especially on the PGM sector. And indeed, anyone watching this would like to get his research, I'm sure we can send that across to you. So effectively, you've got this advisory business. Clients buy their own metal through yourselves, and you advise on a reallocation. I mean, does this happen on a monthly basis or less frequently than that? I don't know. What's the timing on it typically?
Well, with all of the back testing that we've done historically over like a 30-year period, you're averaging about maybe 5 or 6 trades a year, but it's very spasmodic. You could go multiple years without any trades, and then you could go through high volatility periods where you might be doing up to 20 trades a year. But typically, as is the nature with physical metals, we're very reluctant to trade too much. We're only trading when there's a distinct opportunity, a lower risk opportunity. So as a result, we're minimising those transaction costs by not over trading and really just sort of making the most of opportunities.
Let's go into the metal a little bit more detail, Robbie, if you can. So clients would approach you. And I guess you'll be in charge of the onboarding process, or your team would be. What is a typical trade here? £100,000, something of that order of magnitude? I don't know.
The minimum investment threshold for Auctus metal portfolios is £135,000 or thereabouts. It's 250,000 Singapore dollars, being a Singapore registered company. I would say about 90% of our clients are outside of Singapore. UK is a big market for us, as is Australia, of course, but we really have clients now on every continent. We have just over 100 million US dollars under management. And what we're seeing at the moment really is abundance of time buyers of metals who they understand the need for precious metals. They understand the need for physical. They soon learn the importance of not holding paper. And that's something, of course, that we're very quick to assure our clients that, we don't, despite our, annualized net compound returns of plus 43% since inception in 2016, we are not engaging in any collateralization, leverage, or paper trading. It is literally hard physical precious metals in our clients' vaults. And it was mentioned earlier, of course, as an advisory, we are informing our clients very accurately off the back of the information provided to us and signaled by the algorithms how to optimally weight their investment across the 5 precious metals, gold, silver, platinum, palladium, and rhodium, on the very date of deployment of their funds into the metals. And that changes every day. And it's very accurate as well. It's to the second decimal place. And we have no prep for clients being in a gold is very pretty and looks nice to watch. But really, for us, as long as we are ensuring our clients have full ownership title of their metals, that their metals are wholly segregated within their own vaults under their own family name. We use a third-party vaulting provider, a partner of ours, Malka Amit, who are a global company with offices all over the world. They operate in Singapore out of Le Freeport, which is very much one of the leading vaulting houses in the world. I mean, the Freeport in Singapore literally backs up onto the Changi Airport runway. It is described as the Fort Knox of Asia. We've actually seen a number of Swiss clients recently seeking to diversify their own precious metal holdings held in vaults in Switzerland to Singapore to manage their geographical, or I suppose at these current times, political risk as well. And so the clients have their metals in their own vault. They have full visibility of those metals at all times via our bespoke vaulting portal, which allows them to check on their smartphone everything from inflows, outflows, daily vaulting fees, although these are only charged to our clients quarterly, along with our management fees, which I'll get onto in a minute. But it's they can see the value of their metals. They're encouraged to go and visit their metals, something that I've done many times myself. It's a really radical experience getting into the vaults. It's quite Mission Impossible, Tom Cruise, retina scans, etc. It's a highly militarized zone, and of course that affords our clients absolute protection. Our clients come from a diverse background. We have clients who come to us with their gold or silver holdings, looking to get their metals to do more for them without collateralizing it or leasing it, for example. We have first-time clients who meet that minimum investment threshold, who obviously have seen our audited results. We were very rigorously audited over a period of 6 months by BDO Global out of Australia, we share that audit report obviously with our clients. The actual physical metals and vaults themselves are independently audited throughout the year. So it's really a sort of a 360-degree solution that we provide. Clients come to us often, like I mentioned, first-time investors in metals. They're looking for a solution where they can get an outperformance and rely on the integrity of the algorithms and the data and signals that are provided, including, very importantly, when to re-weight or rebalance their metals. And that literally occurs. Our clients have to sign a power of attorney, which allows us to instruct Malka Amit when there is a price trigger event to literally move a metal out of the client and, importantly, replace it with another metal of equal US dollar value.
Let me jump in there if I may, Robbie. I mean, I think it's encouraging, and it's worth emphasising is that there's no counterparty risk attached to this trade, which is fantastic. You've got metal, physical metal, allocated, segregated. You're just enhancing its performance. You mentioned a little bit earlier on there fees. Before we go into fees, let's just look again. It's worth exploring this performance. I think you just said a moment ago, 43%. Is that per annum compounded?
Yes, compound annual growth.
I mean, if you look at gold back to 1971, it's averaged something in the region of 10% per annum over that very extensive period of time. Were you in gold? Yes, you'd be happy with that. You might be beating inflation perhaps over the long term, but you're doing something in the region of 4 times that, if that were the case.
It does look like a ludicrous return, and we do get that from people. We do. Our returns are actually audited, and our clients have experienced those returns. Again, they're physical metals, and all you're doing is revalue them at spot, so it's all very vanilla and fully visible.
We've heard there that the fund has been averaging 43% per annum since 2016. That's a big number. Might scare some people off. What is the detail of that?
Exactly. That is a big number, and it's part and parcel with, I guess, the volatility within the long-term trends. Our back testing has supported us getting around the 20% mark per annum over a long period. And that in itself sounds like a big number. But, when you look at gold over similar periods, achieving an 8 to 10% return, and our algorithms, are basically generating around a 10% return on that gold holding. So when you combine those two together, that gets you to that 20% return.
Now let's go to the other side of the story, Robbie, which is what are the fees? What do you charge your clients for getting access to these wonderful algorithms that Matt has cooked up?
Well, actually, it's very reasonable. Our management fee, based on the minimum investment of 250,000 Singapore dollars, or approximately 135,000 pounds, starts at 1.4% per annum, and that tails off towards 1% as either the value of the client's portfolio naturally increases. We are, of course, in a bull market in precious metals and the entire commodities complex. That is something that can, of course, be expected. Or if indeed clients add to their positions, which many of our clients will do so on a regular basis. We have some clients who send funds on a monthly basis. In addition to that, you have the vaulting fees. We don't take a cut from the vaulting fees. These are third-party vaulting fees. And surprisingly, you may be quite pleased to hear that those average out. Each metal has a slightly different percentage fee per annum, but it averages out at about 0.5% per annum, which I'm sure you'll agree is extremely competitive. Now, the management fee really only serves to help us cover some of the many costs that we have in running our business. Where we make our money, I mean, to be blunt, if I may, is from the performance fee. And we do charge a 5% performance fee to clients. However, it is only charged to them once we have generated a net 20% return for them within a calendar year. We then take 5% of everything over and above that, which I'm sure you'll agree is extremely reasonable. So all in costs under 2% net per annum. But again, our annualized net compound returns are net, and that includes transaction costs when we are reweighting our clients' portfolios.
Fantastic. Thank you on that, Robbie. Well, let's conclude, David, by looking at the world of precious metals. We've looked at this lovely new company, 5 years or so, 6 years in existence. A highly new, innovative way of accessing precious metals by using modern portfolio theory to balance your portfolio, to take account for mismatches or mispricings between each of the precious metals. You've got, research, you've got Matt with his algorithms coming together to come up with a compelling product here. And we talked about the macro a bit earlier on, but let's look at the world in precious metals. Gold seems to be looking quite perky as we speak. Finally, it's been picking up a bit of pace, challenging the $1,900 level, and also the white metals are doing rather well. There's a different vim about precious metals just now. What would you say to a potential investor looking at this space? Why should they be here?
I mean, obviously, every asset class has its day in the sun, as we like to say. Everything has a cycle. What drove us into the metal space, or the precious metal space in particular, was one, the policy decisions coming out of the global financial crisis, and as the way we are analysing the data, we see severe risks of a blow up in a global debt crisis. And hence you've seen the instigation of negative nominal yields and quite extreme negative nominal yields, which again, as far as our macro analysis is concerned, we can't see interest rates moving back into positive territory because of the sheer weight of the global leverage and global debt that the world is effectively carrying. And now the financialization of the stock markets and various other asset classes, including property, where central policy decisions have moved cash and leverage into, has effectively removed capex from the commodity complex. I mean, we've seen a severe fall off in capital expenditure and investment within the whole commodity complex. And when we look at precious metals, one, we look at it as a revaluation based off a monetary debasement is effectively what we face, or what we are actually going through at the moment, driven by negative nominal yields. But then we look at the individual metals, such as the PGMs, platinum group metals. They're driven by significant and severe changes in their whole supply-demand makeup and picture. We saw this with rhodium moving from just below $1,000 an ounce up to nearly $30,000 an ounce last year. So you saw roughly a 30 times move in rhodium. You saw a 500% move in palladium. We're effectively out of those metals now. Platinum, that whole supply-demand picture is changing rather dramatically at the moment. Falling ore grades, the substitution of platinum within the catalytic out of palladium, and also the new pollution controls that are coming in, from China and Europe and America. Car companies actually can't put a car on the road these days within the combustion engine. Can't put a car on the road without very heavy weightings of these particular metals. And now that whole makeup is being moved very aggressively into platinum. And then you have severe problems with South Africa itself. South Africa produces roughly 75% of the world's PGMs, particularly platinum, which is 72, 73%. And they've got severe problems. 1, ore grade degradation. 2, the cost of production. 3, Eskom, which is the utility provider of energy. They've got rolling blackouts now across South Africa through, I wouldn't call it malinvestment, I would call it non-investment into the infrastructure, driven by a somewhat corrupt government. And this has had knock-on effects within the industry itself. For example, in the second half of this year, the main platinum group producers are turning off their furnaces to be rebuilt. They've been critically damaged by Eskom and the rolling blackouts. And this is changing the whole shift. This new demand numbers coming through, particularly driven by the catalytic side, and then you've got the hydrogen economy. And people really underestimate the hydrogen side of the economy. In 2021, most forecasts looked at the hydrogen economy taking up 65,000 ounces of platinum. That's a significant number, and that's looking to rise quite considerably over the next few years. So you can't discount the hydrogen economy. People will generally come at us and say, well, electric vehicles are going to take over the world. Well, we won't necessarily argue for or against that. But in the shorter term, we've got a 3 to 5 year trading horizon. I don't have a 10, 20, 30 year trading horizon. None of us do. We're looking at significant supply demand deficits in some of these metals, and the prices will be driven higher. And then you've obviously got the icing on the cake, which is the macro picture, which is the significant global monetary debasement that we face.
I don't think you're alone, David, in believing that there's a cycle to things, and precious metals, but in commodities broadly, are very much.
Yeah.
Goldman Sachs, Jeff Curry, perhaps you saw his recent interview saying we're in one of those phases where commodities are going to go very, very quickly, very strongly higher. Now, gold may have missed the memo last year on inflation, but the white metals certainly outperformed, and I know you rode that trend very well. Year to date, precious metals are also doing very well. Gold up 5%, silver 4%. And the white metals up double digit again. So again, it's quite clear that we're back into a commodity bull run once again. And I think this is a very fine way of playing this particular game. It allows me just to say thank you to each of our speakers here, David, Matt, and Robbie, for your time. For anyone who's watching this that would like to get in contact with you, you'll see the contact details coming up, and I suspect you can wait to hear from Robbie, who'll be very pleased to talk to you further. Thank you,
Thank you very much, Ross. I appreciate it.
Cheers, gentlemen. Thank you.
Thank you.
Thanks, Ross.